Welcome to the Explainer. Financial charts can often look like this chaotic, completely erratic battlefield of price action. But what if it's not random at all? What if it's actually a meticulously recorded map of human psychology? Well, today we're completely decoding the seemingly chaotic financial markets by uncovering the hidden battle between buyers and sellers. We're going to master the timeless concepts of demand and supply.
Okay, so here's our agenda for this explainer. We're going to start with technical analysis basics, move right into support and resistance zones, and then visualizing market data. From there, we'll cover proven trading strategies, look at the actual academic evidence, and finally, wrap up with essential risk management. Let's just dive right in.
All right, kicking things off with Section 1, Technical Analysis Basics. So before we look at a single chart, we really have to understand the core beliefs that drive this entire discipline. It all starts with a foundational concept from Charles Dow developed way back in the 19th century. The core tenet of Dow theory is simply this: the market discounts everything. This essentially assumes that all possible price-sensitive information, whether it's a surprise earnings report, global news, or shifting fundamentals, is absolutely already built into the historical price graph of a security. Simply put, the price tells the whole story.
And that brings us precisely to what technical analysis actually is. It's the study of historical stock price graphs and momentum to identify patterns. Now, in this approach, we completely skip the fundamental balance sheets and profit and loss accounts. We assume that price movements follow specific trends and, crucially, that history tends to repeat itself. Why? Well, because market participants provide consistent, predictable reactions to similar market stimuli over time. We're essentially analyzing human behavior.
Moving right along to Section 2, Support and Resistance Zones. So where does all this human behavior actually show up on our screens? Well, it happens right here in the trenches. First, we have support. This is your floor. It's the demand zone. It's that price level where a massive surplus of buyers steps in, thinking, oh wow, this is cheap, and their buying pressure completely prevents the price from declining any further. Then, on the flip side, you have resistance. This is your ceiling, the supply zone. Up here, a surplus of sellers steps in, thinking, okay, it's time to take profits, and their selling pressure actively caps the rise.
To really grasp this psychology, I love the hot pizza pan metaphor from trading psychologist Dr. Walter Peters. Think of a strong resistance level like a pizza pan that just came fresh out of the oven. When the price first approaches this hot zone, it gets burned and retreats. So the next time it approaches, it does so with extreme caution, carefully testing the area. Markets literally have memory. These zones create deep psychological imprints that traders remember for weeks, months, or even years.
But of course, we know these zones aren't impenetrable brick walls. So what happens when a ceiling finally breaks? Well, we call this the apartment building breakout. Imagine you live on the ground floor, and your ceiling is resistance. But if you take the stairs and break through that ceiling to the first floor above you, your old ceiling just became your brand new floor. When a resistance level is breached by aggressive buyers, it transforms into a new support level. It represents a total fundamental shift in market sentiment.
All right, that takes us to Section 3, Visualizing Market Data.
So we understand the underlying theory, but how do we map this out accurately to actually build an actionable framework? When you open your charting software, you've got a couple of options. First, you have line charts. These only show closing prices, which brilliantly filters out all that intraday market noise. Then you've candlestick charts, which show the extreme highs and lows, basically the market's sudden jerky reflexes. A really great tip from the pros is to plot your support and resistance zones on a line chart first. It really helps you focus on the market's intentional movements before you add in all those confusing wicks from the candlesticks.
So the absolutely crucial point here is this: you need to draw thick zones, not thin lines. Demand and supply areas act as broad zones. If you go in and draw a perfect single horizontal line, you are going to get tricked. Markets chop around, they intentionally trap traders. You should realistically expect these zones to be 30 to 40 pips wide. You're looking for a general area where the price is likely to reverse, not a specific, to the penny trigger point.
Let's put this into practice with Section 4, Proven Trading Strategies.
Now that our zones are drawn on the chart, how do we actually trade them? Enter the firsty trade strategy. This is designed to catch new trends right at their absolute genesis. Step 1. You draw your zones and overlay your 60, 150, and 365 exponential moving averages. Then the hunt begins. You wait patiently for those EMAs to fan out and separate, signaling a brand new trend. But listen, you don't chase it. You wait for the price to exhaust itself, pull back, and perfectly kiss both the moving average and your drawn zone. That right there is your trigger to enter the trend, tucking your stop loss safely just beyond the trigger bar. Another highly effective strategy is trading the famous head and shoulders pattern when it forms right on a support and resistance zone. But this brings up a really massive question for traders. How do we know exactly when to enter a head and shoulders breakout once it actually crosses that neckline zone?
You've basically got two distinct choices here. The first is the aggressive entry. This is where you sell on the open of the candle immediately following the first close below the neckline. It definitely gets you in early, but it naturally carries a lot more risk. The other option is the conservative entry. Here, you wait for the market to break the neckline a second time with way more conviction, or you just wait for a retouch bounce, where the price breaks, comes back up to test the neckline, and then falls. Whichever route you choose, you have to remember the golden rule. If you miss a trade, do not chase it. Just let it go.
Let's look at the hard numbers in Section 5, the academic evidence.
Now you might be wondering, is this all just a bunch of charting theory? Well, let's look at some empirical data from a 5-year study by researcher Samuel Talbot et al. Look at the returns comparing a basic buy and hold strategy versus an active support and resistance strategy. In the Johannesburg Stock Exchange, buy and hold actually lost 20.33%, while the support and resistance strategy made a positive 7.75%. And in the German DAX, buy and hold made 11.05%, but support and resistance outperformed it with 13.57%. The active strategy clearly wins out.
But honestly, it's not just about the absolute returns. It is entirely about the risk you take to achieve them. Get this, the support and resistance strategy achieved a massive 100.38% Sharpe ratio in the DAX. This proves mathematically that setting entry points slightly above support to confirm a reversal and selling near resistance provides abnormal profits with significantly lower risk than just blindly holding on to an asset through market turmoil. Finally, we arrive at the most vital piece of the puzzle, Section 6, Essential Risk Management.
Listen, getting the market direction right means absolutely nothing if your risk isn't strictly managed. These are the non-negotiable rules you must follow. First, never risk more than 5% of your account on any single trade. And ideally, you want to keep that to 2 or 3%. If you have a $10,000 account, the maximum you can possibly risk is $500, period. Second, always, and I mean always, use stop-loss orders. Third, utilize trailing stops or previous highs and lows for your exits so you actually secure your hard-earned profits. And finally, you have to exercise extreme discipline. Do not force trades. Entering a position without these rules isn't trading at all. It's just pure gambling. Which brings me to the final question I want to leave you with today. I want you to look at your own habits. Are you trading based on historical evidence and strict, unwavering discipline, or are you just blindly gambling on the chaos? The market is a mirror of human psychology. If you can master your own, you can absolutely